Here today from Witham is Kimberly Phelan and Josh Galernter, two members of the firm's International Tax Group. Today they will talk to us about the recent changes the CARES Act made with respect to net operating losses and how they impact taxpayers with international activities.
Good morning, good afternoon, everyone. Kimberly, why don't you start us off talking about how the changes are going to impact Section 965 transition tax and deemed repatriation from 2017.
Great, thanks, Josh. So the CARES Act introduced the NOL carryback, but before that, the Tax Cut and Jobs Act of 2017 introduced a number of international provisions. And the first one was the Section 965 transition tax or deemed repatriation. Now, if you carry back an NOL to that year, which is the 2017 year, or the year of the taxpayer that includes December 31st, 2017, that year, all taxpayers that owned a specified foreign corporation had to repatriate all of the non-previously taxed earnings and profits, but they got to be taxed at a preferential rate. So if you carry back an NOL to that year, you may reduce the tax, which would also reduce the deemed dividend that was taxed at preferential rates. So you won't get back the full amount of tax. But a bigger issue might be that if you carry back to that year, instead of getting that tax back, they would just apply that overpayment to the 965 tax, which you were allowed to pay in over 8 years. So it's not just about how much the NOL will impact the actual tax, but also how much of the 965 tax you've pushed out 8 years, and the NOL carryback will relieve tax and it will go to that. All of this is part of just realizing that there are many moving parts for taxpayers with international activities. So it's not just as easy as what's my NOL times what's the tax rate. Another piece of the change was the GILTI, the Global Intangible Low Tax Income. Josh, you want to tell us about how an NOL carryback might impact GILTI?
Absolutely, thank you, Kimberly. So as Kimberly mentioned, the Tax Cut and Jobs Act had a number of international tax provisions. Kimberly discussed the 965 transition tax, and GILTI is a similar concept that all foreign income that's earned by foreign corporations that are owned by U.S. shareholders will also be subject to tax on a yearly basis going forward. There is no opportunity to defer the income from being subject to U.S. taxation. Now, one of the interesting things about GILTI is how it's taxed to a U.S. shareholder and the difference between whether that shareholder is a corporation, a C corporation, or an individual owning the shares of the controlled foreign corporation directly, or through an S corporation, or through a partnership flow-through entity. The individual is going to be subject to tax at their high rate, at the individual's higher rate than the corporate tax rate. The individual is not going to be eligible for the Section 250 deduction, which we'll talk about in more in depth in a moment. And furthermore, the individual will not be will not be able to utilize foreign tax credits that relate to GILTI income that flows up to the individual through the GILTI inclusion mechanism. A corporate tax shareholder, on the other hand, however, will be able to use foreign tax credits and will be able to utilize a Section 250 deduction in which the U.S. corporate shareholder will only be subject to tax on 50% of the income that the foreign subsidiary earned, assuming that the U.S. corporate shareholder is in a net positive income position and pays tax at the U.S. level. So thinking about whether it makes sense to carry back losses from the 2020 year back to 2019, 2018 to offset GILTI income, again, as Kimberly said, in respect to the, as it applies to Section 965, it pays to consider all of the different factors that are involved in GILTI and whether, in fact, you'll get the most bang for your buck, so to speak, by carrying your NOLs back to offset GILTI income. From the corporate perspective, you're going to be not getting that 100% NOL utilization because the income had been subject to a lower tax rate. For an individual where it's going to be subject to a higher tax rate, maybe there's more possibilities to think about utilizing the carryback in that situation. So again, the takeaway from this is that there's a lot of moving parts, a lot of different things to think about, and there's no one size fits all solution, and everyone should consider how the rules will impact them and their specific fact pattern. Kimberly, would you like to continue the discussion with respect to FDII and BEAT?
Sure. Again, 2017 Tax Cut and Jobs Act. The Foreign Derived Intangible Income, or FDII, applies only to C corporations, and it provides a reduced tax rate of 13.125% on the foreign sourced income earned by a U.S. taxpayer in excess of their 10% return on the QBI. So if we have a corporate taxpayer who has claimed the FDII in 2018 or 19 and carries an NOL back to that year, you're going to reduce that FDII first, because we eliminate the Section 250 deduction, which provides for the reduced tax rate. So again, that NOL might not be as great as expected because you first claim the NOL before you claim the 250 deduction. So you're basically taking reduced taxable income and using a refund against that reduced tax amount. So you want to model out back or forward with that NOL. Another piece of the 2017 Tax Cut and Jobs Act is the BEAT, the Base Erosion Anti-Abuse Tax. This only applies to pretty large taxpayers, taxpayers with greater than $500 million in gross receipts. And what this does is it takes your taxable income and it adds back your base erosion payments if those payments are greater than 3% of your total expenses. So you take your taxable income, any base erosion payments, which are payments to foreign related entities where that entity is not subject to US tax, and you take that new much higher amount and it's subject to tax at 10%. So if you take an NOL back, you might reduce your regular tax, but the BEAT may still kick in. So this is another example of where you'll carry back the NOL, but you might not get full value because of all of these various issues with international, the 965, the BEAT, the FDII, and the GILTI. There's one more very important part of what happens when you use NOLs, and that deals with foreign tax credits getting released. Josh, you want to tell us some of this, what's coming with foreign tax credit?
Thank you, Kimberly. Thank you, Kimberly. Yes. So just a couple of weeks ago, the IRS released a revenue ruling 2020-08, in which it announced that it is going to be reconsidering a special 10-year limitation period for foreign tax credits that are freed up by the result of NOL carryback. So to make a complicated situation as clear as possible, if you have losses in the current year, let's just use the current year 2020, that you're going to carry back 5 years, you carry those NOLs back to the 2015 tax year, and you had foreign tax credits in 2015 that had been used to offset U.S. taxable income, and now the NOLs that you carry back wipe away that income. So now you've just freed up some foreign tax credits that had previously been utilized. And the question is going to be how long you have in order to be able to utilize those foreign tax credits. So what the revenue ruling said is that the IRS is going to be reconsidering this 10-year carry forward rule. Currently, there's no change to that, but the IRS announced that they're revisiting this previous ruling that was issued way back in 1971, and further guidance is expected within the next couple of weeks about how exactly that's going to work out. So stay tuned for further developments in the foreign tax credit area as it relates to NOL carrybacks. There's more to come, and we will provide you more information as it becomes available. Kimberly, thank you very much. Turning it back to Alice.
Stay tuned for more updates and changes from Witham as new guidance is released.